episode, like a bullet train there. I think, which means we have about 20 seconds to
I think
go
he
for
needs a
market
shot
open.
of that Kalpis drink himself that he's speaking about, Varun Beverages.
All right. Well, Varun and Bajaj Finance are the two names in focus as far as the brokerage radar is concerned. I think market open coming up in a couple of seconds, basically, and we'll pick it up from there. I think the IT stocks will all be in focus. I think in the pre-open, they're all down between 3 and 5%, at least the large cap ones. They'll settle and we'll sort of, look back at them. Even the mid-cap names in the pre-open are down between 2-3%. So, at least the SAR is not, that large down, but it is down. 0.8, 0.9 lower on the Nifty, so in line with the GIFT Nifty, 23,975. You've got the Nifty Bank, which is down 0.4%. The Sensex is down 0.8, 0.9. The small cap index also should flip into the green. That's yesterday's close. The small cap index is down about 0.25%. Yeah, there you go. So across the board, there are cuts, but the broader markets are doing better. Small caps in specific are down the least. So the tech names are all there at the bottom of the screen. And I think that's where the pressure is coming from. Maybe just look at the Nifty IT index as well. Yeah. So, oh boy, 6% lower. Maybe it's got to come from the large caps, right? TCS, Infi, etc., which we will also just look at. Nifty heat map, I guess, should give you that sense. The top 4-5 losers will all be IT. There you go. Infi, TechM, HCL Tech, TCS, Wipro. Those are the top 5 losers. On the other side, you've got Bajaj Auto, Cipla, Sun Pharma, and Apollo Hospitals, which are higher. So you've got about 10 names up and about 40 lower. So that's the lay of the land right at the word go. 23,940. Mangalam.
Well, it's a lot better in the broader markets. The advanced decline split is right down the middle, and we do have an equal number of stocks which are advancing and declining. On the declining side, obviously, you do have a lot of the mid-cap IT companies as well. But if you look at some of the gainers, you have Amber, the deal with Oppo doing extremely well for them. You do have follow-on buying that we're seeing on names like Varun Beverages and Nykaa as well. HFCL is one that stands with a gain of almost 5%, and we are seeing some traction in Angel 1-2. If you look at the losers, Persistent Systems down 6%, Emphasis down 5%, LTM down 5%, Coforge, Birlasoft. So off the top, 8 or 9 FNO losers, you have all of them in the mid-cap IT pack. The only one which is actually a non-IT stock is probably Prestige Estates, which is lower by about 3%. But in the broader markets, look at G&G Electronics. We had the management join us last week as well. There was a large trade. The company was fairly optimistic on its, refurbished laptop business, up 10%, locked in upper circuit at open itself. Textile companies doing extremely well. SP Apparels for one, up around 5%. MTAR Tech, can't take that stock out of equation as well, has crossed past its earlier high and now is recovered all the losses that we saw on account of the uncertainty that we're thinking of. Bloom Energy up nearly 4%, 310 higher on that stock. Viatech Wabag is the other one, which is higher by 3.5% as well. So the mid caps, yes, they're lower, but not as bad as the large caps would have you believe.
Well, that's right, Mangalam. A few stocks, just to add to the list that are doing well. Diamond Power, that's another stock. There was some positive news flow on that one. So that stock has opened gap up in today's trading session. It's holding with gains as well. They've got a board nod, I think, for a QIP, if I got that correct. So 2,000 crore QIP, that one's up and about. Now, there's good news coming in for Amber because they will make phones for Oppo. However, some part of the street is a little bit concerned. What does it do with the current relationship that Dixon has with the group? Will it be some competition out there? We'll have to see how the volumes are split. For the time being, Dixon is down close to under 1.5%, but that is one of the fears. So some clarity on that front will be important. And from Dixon's perspective, we are waiting for the positive news flow with regard to the JV with Vivo. So that's going to be an important monitorable. For the time being, Dixon down close to around 2%. The other couple of names that are moving around, HFCL has returned back to its winning way, so that's up close to around 5%. Angel One saw a bit of a knock a few trading sessions ago. That as well has popped up in trade. The tech pack is down. The Nifty IT index, well, that's breached the 27,000 mark, which effectively means it's made a fresh 52-week low. The earlier low was 27,080 odd. So that one's breached that level. It's down close to around 6%. You want some kind of stability because that's one leg of the market that's actually dragging itself. Vedanta Group companies, Vedanta Iron and Steel for the last few trading sessions, that's been moving from circuit to circuit. It listed at the lower end of that sum of parts. So that is gradually, now in fact it's seen profit taking. It started up close to 3%. Now it's getting sold in two. So after the last few trading sessions, upper circuit, that one is a little bit lower. What else? Nelco is up close to around 6.5%. JNE Axles as well is up close to around 6% as we speak. Good up move is what we're seeing out there. Nifty has managed to defend the 23,950, barely so. But the Nifty Bank actually has seen a good recovery while the IT index is dragging down.
Yeah, 150 points off the lows on the Nifty Bank right now. It's curtailed its losses to just about 160, 70 points after opening about 350 points lower. And Reliance, just pull up that stock. That too has opened fairly well in the green right now and holding with a gain of almost, a 0.25% ahead of its annual general meeting. So if this big boy moves, we will see some traction out there. And before tossing it back to Prashant, just look at Bata. Was up 17% in yesterday's trading session. Some bit of profit taking which is taking place right now. It'll be very interesting to see whether that dip on Bata is bought into right now or not. Because if you're buying the stock from a management change standpoint, then obviously these dips would be opportunities for those who are looking at 17% on uptake yesterday.
Absolutely right. So a little bit of pullback out there in Bata. But otherwise, I mean, it's 200 points lower as we speak. And things with management change, I mean, the thing is, you've got a timeline, some period of suspense, right? Till the point that you actually hear from the new man at the top. Which means that, I mean, typically they would be perhaps, you'd hear them here on CNBC, or they would be perhaps an analyst call, or there'd be, something where the new management will articulate the strategy, etc. And that strategy the market may like it, may not like it, but the point is, till that point, whenever that point is, you can hope that it'll be to the market's liking. So, in any case, as I think Mangalam has been highlighting. Stocks done pretty poorly, but our numbers have also been pretty poor for the last couple of years. So that is Bata for you.
One more stock, Prashant. Yeah. MTAR Tech, that Bloom case played out. The stock saw a sharp correction. It's making a fresh 52-week high, 8,500 rupees. Just take a look at the way that stock is moving. Massive volumes in the first few minutes. Yeah. And it's up close to around 2.5-3% odd. In a world of its own, blooming away. And it sees 10% kind of pullbacks once in a while, yes. like it saw, and then immediately it once again goes back. The last time it sold off 10% was that confused. There were some reporters that a project has been cancelled or deferred, etc. And we had them on, and they said, well, nothing, absolutely nothing at all. And they're, if anything, they're being pressurized to ramp up capacity to meet the demand. From Bloom, which in turn, of course, is supplying to hyperscalers in the US. So that is the picture. And we're down 195 still on the index at this stage. Well, let's welcome in Neeraj Seth, founder and CIO at 3R Investment Management. Neeraj, good morning. Good to have you with us here. Thanks for joining in. Just your sense, Neeraj, what is important from an equity market point of view here in India, you think? You'd marry the macro and the bottom up. Macro-wise, things is looking much better compared to 10 days ago.
Good morning. Thanks for having me. I do think there's slightly better backdrop here for India. Much more for sure from a macro perspective. Obviously, you're watching the dollar INR move over the last few days. So combination of the oil price decline and all the measures that we saw from RBI, I think very welcome, and the markets are reacting to it. And in reality, in fact, on a relative basis, the Indian rupee is outperforming all of the other Asian currencies at this point, because we have seen a move up in the dollar against all majors. So clearly, INR is showing strength, which is one of the ingredients of the confidence from a foreign investor perspective. Equities, I still have a little bit of a caution driven by the IT services sector, but more at a sector level, there are some positives there. So I think all in all, mixed picture with some caution on IT services that will remain.
Caution on IT services will remain. What about financials? Because that kind of is more tied in a straight way to what's happening on the macro-ish front, right? And that's a space which is done so poorly. Large private banks. Neeraj.
So I think financials, I would argue, are actually better placed in India. It's obviously, we'll see a continuation of a credit growth in the system. The corporate capex, I would expect to start seeing some traction as we go into the later part of the year. So I think the financials are actually well placed in terms of where they are, in terms of the NPL cycle, credit growth, and the margins from here.
Hi, Neeraj. Good to see you. As you said, the rupee stabilizing is good news, at least just in the near term, because it fell one way, 89 to 97, I think, between December till a couple of weeks ago. That said, what about the FI flows? They've been underweight India. They've been selling various emerging markets, but they've also been getting heavy into this AI trade, which is lacking out here. Do you think the FIs gradually come back into the Indian market since the pieces are coming together? Crude is down. There are measures coming in from the RBI to stabilize the rupee as well.
So I do expect the FIIs to move towards a neutral, but I don't think there's going to be a significant shift beyond that. And part of it is driven by what you see. The global equity impulse is very much an AI trade. And you see that in Asia playing through mainly at this point, Korea, Japan, and Taiwan. So you're not seeing a broad-based rally across the region. In fact, even China has been underperforming over the last few months. So I don't think that's changing unless you see a pause in the AI-driven rally and the broadening of that, which could happen, but I'm not sure we are there as yet.
We're speaking about the AI-driven rally, and can't not once again speak about the IT pack, Neeraj. At least today, the IT index down about 6% right now, with stocks like Infosys, TCS, HCL Tech, Wipro, all of them falling like 9 pins. Infosys down 8%, TCS down 6%. We have a bigger gash on, some of the mid-cap names as well. In the past, you've said that there is an opportunity for Indian IT companies to pivot. We've seen some signs of that. HCL Tech has made an announcement, about 10% equity in Sarvam AI. Is that significant enough for you to actually look at it after a decline, or maybe you'll wait this rally out, or are you tempted?
So I would still be cautious, and part of it is driven by what you saw, obviously, the Accenture guidance, which the EPS was fine, but the concerns are about the forward revenues, and hence, based on that growth or some shrinkage of the business, what multiple do you put at that? So I don't think we've seen completely the end of that, because obviously the AI theme broadly is still evolving. I do think we will see an opportunity in the sector, but it still might be 1 or 2 quarters away. And on your point about the pivoting towards the AI theme, it's early days. I don't think, looking through the numbers, that it has started to show up for any IT services business in India as a meaningful move. It's early days of the trying to pivot, but most of the revenues are still from the traditional business.
Yeah, got that. Do you have any strong views on precious metals, Neeraj? We're seeing a bit of a move lower on gold and silver. And there are a few, basically on the lending side, there are a few companies which have done phenomenally well. So just your thoughts.
So long term, I still remain bullish on the precious metals. Near term, I do expect to see some pressure. Part of it is also driven by, if you are watching what's happening in the US, the FOMC, there's certainly a shift there. In fact, there's a biggest evolution in the monetary policy we are seeing right now, as we see the new chair coming into the Fed committee, and obviously is slowly trying to move or pivot towards a different way of monetary policy. In fact, in my mind, we're going back to the Greenspan era. And the hawkish hold from the Fed, because of the inflationary backdrop, I think that'll keep some pressure on gold in the near term. If you take a 12 to 18-month view, I'll still be a buyer of gold from a broader portfolio allocation perspective.
Okay, got it. And what should, just asking you off the cuff, but what kind of exposure should you be having to gold? 5%, 10% of portfolio?
I'm normally a believer that gold between mid to high single digits still has position in the portfolios.
Indeed, in the last 2 years, if you had a larger position, you'll be happier. But, that said, what about, some of these export-oriented names, the textiles companies, everyone was scribbling about the rupee weakening, but some of these companies actually could potentially gain. And some of those headwinds, particularly for sectors like textiles, they're going to be turning around because the India-US trade deal is, likely to get finalized. You have FTAs signed with various other countries as well. And the rupee weakness actually should do well. Any view on that space?
I'm actually positive on that sector, given where the rupee is. And to your point about the additional trade deals that have come in play, I think a lot of that will start getting traction in the coming quarters. And I do think the benefit will start accruing to these businesses in terms of the growth in exports, and the operating leverage.
Okay.
Right. Is there a play there? Because, it's such a narrow set of stocks that not a lot of funds can buy a lot of volumes.
So it's not a Nifty play for sure, because it's a very small part of the index.
Exactly.
It's again more of a bottom-up security selection and more for the smaller, nimble funds rather than a big player taking a big position, because you don't have as much of a float in the sector right now.
Okay. All right. Neeraj, we'll leave it there. Thank you very much for joining us. Good speaking with you. It's always a pleasure having you on. Well, let's just stick with the textile theme, and let's welcome in the management of Gokuldas Exports, who's with us. So Siva Ramakrishnan Ganpati is Vice Chairman and Managing Director at Gokuldas. He's with us now. Siva, good to have you with us here. Good morning. Thanks for joining in. So let's just first start with the UK-India FTA, which comes into effect on the 15th. What does this do for Gokuldas? We've spoken about this in the past, but just revise our memories.
So India-UK FTA gives us duty-free access into UK and puts us at an advantage vis-a-vis China by 12%, because China goes with a 12% duty. Bangladesh, Vietnam goes duty-free. Now India gets a level playing field with two competing countries, namely Bangladesh and Vietnam. And vis-a-vis China, we get 12% advantage. Obviously, this is a huge constraint lifted on India. And, for us, it allows us to expand our business into UK. We already are working with 3 large companies in UK. And naturally, the expectation is that the business volumes in terms of exports to that country will grow. As an opportunity for the country, if you look at, the numbers, India's exports into UK is only about $1 billion, whereas, if you look at Bangladesh, it's about $3.5 billion. And China is still at $5 billion. Of course, a lot of it is MMF based, where China has a natural advantage. But if you look at, some degree of rationalization, now that both countries, Bangladesh and India, will have equal zero duty access into UK, there will be a little bit of pivoting by the UK-based customers into sourcing from India just for diversification reasons. And with competitiveness established with China, there'll be some movement of goods from there to India as well. I would think it's a more than $1 billion opportunity for India as a whole.
So basically, you're saying exports to UK for India could move from $1 billion to $2 billion?
It could.
It could.
Bangladesh is at 3.5, so there's enough headroom there.
Okay, got that. And the currency, recent currency, sharp appreciation in the yuan also helps? I mean, in terms of competitiveness?
Always helps, right? I mean, it's always a relative advantage. And a weaker rupee vis-a-vis other currencies is always a plus for India.
Yeah. But how does it, the point is, even after the move, right? I mean, I think we can all agree the yuan is hugely undervalued. It's kept undervalued. So it depends on when they allow it to appreciate more or whatever. I mean, we don't know. But how does this play out, the currency advantage, if it stays at these levels? We stay where we are and the yuan stays where it is now. You think it's a big one?
I think if we stay where we are, I mean that's a big if. I don't know how Indian currency will move going forward, but at the zone where we are, I think it's a major plus. From an exporter standpoint, we always would like to have a competitive scenario vis-a-vis our competing countries. China is not the only competitor. We are also compete heavily with Bangladesh and Vietnam. And, overall Indian rupee weakening over the last, several months has definitely helped us boost our prospects when we do our costings for the future quarters, etc. We do have some advantage there.
Right. Siva, let's now talk to the other big market, much bigger market, which is the US, right? Here, we've been, the higher tariffs were cut down, and I think what are tariffs now to the US?
10%.
10%. But
that's reciprocal tariff, and then there's underlying tariff on the products, which vary anywhere between 14 and 32%.
Okay. But this reciprocal tariff will not. It's expiring, right? It's got in July sometime.
Indeed, it's expiring on July 24th.
So what will come after 24th of July is the big question, right? Which everyone is wondering. Yesterday, we had an economist from JP Morgan based in Washington who said, well, all these 301 tariffs will start to kick in.
Right.
And it was not about one sector of this, but I mean, he was just saying that, well, watch out for that. That's a risk. But just your thoughts on this.
So we need to see what the India-US BTA will come up with. There is a lot of expectation that it will be positive for India, as there is considerable amount of dialogue going on between US trade representatives, India at a political level as well. So subject to that, which we don't know, I think the general expectation was that India would go back to about 80%. We have to wait and watch as to see where it is. But I would place some faith on the India-US BTA, which is being worked out. As long as we have a level playing field vis-a-vis competing countries, namely other Southeast Asian countries, we are good. If we have an advantage over them, then it will be an awesome event for Indian apparel exports.
So what you're hoping for is that before the 24th of July, we have a BTA in place, which then addresses this.
Right, that's correct.
Got it. But would you imagine, and typically what would this be? Like something we've seen with India-US? India-UK, or how would it be?
I don't know. I don't want to speculate. Let the negotiations play, and let's hope for the best. As I said, if even the worst case is we should come in the border of 20s. But if it's anything better than that, that would really improve the prospects of this industry going forward. That would be a massive constraint being lifted on India.
Okay. You're saying the not the underlying product tariff, but this 10% is in the vicinity of 20, settles in the vicinity of 20. That'll be okay.
That's the general expectation. See, as the 10% is today 10% for everyone in the world. So that's a level playing field. If that 10 goes to 20, still it's a level playing field. So what I'm saying is that we came in when we were 50 at an unlevel playing field where there was huge millstone on India's neck. Now we've got a level playing field. Look at how, the business volumes have started surging. Now, as long as there is a level playing field, we are good. But if there is a playing field which is tilted towards India, which historically many other regions have enjoyed, we would really benefit from that window of opportunity where, a lot more investments can go into Indian apparel manufacturing and a lot more business would move. And once a business moves into a country, it stays there. So, it also has got a cascading effect on the value chain where, accordingly, the fabric ecosystem and all other ecosystems also start developing to support that. Keep in mind that export-oriented industry demands a very high quality. So that really sets up a high-quality supply chain out of India. And once that is done, then that becomes a competitive advantage.
All right. Hi, sir. Good morning. Good to see you, Ben. Thanks for giving us fair color on all those issues. Let's focus on a couple of other things then. BRFL, that's come into your fold now, and I understand it's got approvals from a lot of global retailers, which is great news. Could you tell us in terms of utilization levels, what is it functioning at now? And say by FY28, what kind of EBITDA contribution can it give? By when does it break even first, and EBITDA contribution in FY28?
So the process of merger of BTPL is on, and we anticipate that to happen in the third quarter of the current financial year. Okay. So at the moment, BTPL is more or less kind of EBITDA breaking even, and the expectation is by the end of second quarter or early third quarter, we should see it generating about mid single digit EBITDA margins, and its capacity utilization is growing. At the moment, it's about 50-55%, and it should start climbing up to about 65-70% by then. In the next year, we should start seeing BTPL also contributing to a double-digit EBITDA margin going forward.
So ballpark,
as you know, we are seeing good traction coming in from customers. Many of our customers have started nominating BTPL for its fabrics.
Yes.
We are seeing that the fabric quality and consistency is pretty good. So a lot of those production-related issues, technical issues, have all been sorted, solved, and the output which is coming out of that factory seems to be consistently on an upward trajectory.
So BTPL could do around 175, 200 crores in FY28. Would that be possible? Would that be an aspiration?
What's 175 to 200
EBITDA contribution?
That would be more like a FY29 expectation from BTPL.
Got it. In the next 2 years, the street is very optimistic. For the last year, the net profit was close to around 100 crores. But with the approvals that are coming in there and a lot of those headwinds now gradually turning into tailwinds and business returning back to normalcy, people expect the profitability maybe to triple in the next 2 years. Is that possible? FY28 net profit number goes from 100 crores, which was on a depressed base of last year. Does it go to around 300 crores in FY28?
As they say, "Aapke muh mein ghee shakkar," but that
you have my best wishes, sir. But shareholders want to know whether or not it's possible.
Yeah, definitely. It's that's the right expectation. That's what we're all working for. Last year's was an exceptionally depressed number, primarily because of the huge tariff. So obviously, once that burden is lifted, that itself will give a fillip. And then we're looking at the growth trajectory. The directionally what you're saying is making a lot of sense.
Well, we wish you well, sir, and thanks a lot.
Siva, just one last question. How is the demand environment in both in this particular season, US and in terms of ordering, etc.? It's all full up?
So far, so good. All full up.
US and UK as well?
That is correct. And Europe as well.
And Europe as well. And since I have you, do you think in the down the line in terms of cotton, yarn, etc., but you are further up in the value chain, this rainfall situation will make a difference at all in any which way?
Oh, that has to be seen because we don't know. But I'm expecting that cotton prices to cool off a little bit. Let's hope for the best.
Okay. All right. So we'll leave it there. Thank you very much. Appreciate you joining in and speaking to us here on CNBC TV 18. Interesting conversation. Very useful to get all those details. We'll take a break. We are back with the management of Kirloskar Ferrous. Stock's done very well. And Mr. R.V. Gumaste is going to be with us for that conversation.
Welcome back. You're tuned into Corporate Trader. Well, the next company on our radar is Kirloskar Ferrous. Remember, the company yesterday had spiked up in trade because they bagged a new export order for pig iron. The value is just around $13.5 million. And the shipment is to be completed by August 2026. To understand more about this, we're joined by Mr. Gumaste, the managing director at Kirloskar Ferrous. Hi, Mr. Gumaste. Good to see you in, sir. We thought it wasn't a very large development, but the street said that they are very excited about this. So give us a few details. It appears this 30,000 tons is around 4% of your volumes. If you could confirm that and give us some color on the buyer. Is it a foundry? Is it a steel pipe maker? Who is it in the UK?
I think the consignment is going to Africa, not to UK. UK is the buyer. And really, it's not really a big excitement as such, but the difference between earlier exports and now is that we exported some small quantities in containers, but this time it's going in a big shipment. As you know, international pig iron prices have moved up very substantially, very smartly, and making it possible for interior plants like ours to export pig iron. I hope that this should open up opportunities for us. Whether it will happen or it's going to happen one-off export, I really don't know. But I think it's a big development as far as the international price of pig iron is concerned. And it's an encouragement to us.
You know, Mr. Gumasti, if I put in the math, it appears that the rough calculation appears to around 43,000 rupees per ton, right? If I, just do a basic mathematic. And that is more or less in line with domestic prices, but you're saying the pricing is favorable. Explain why. And is it margin accretive?
Actually, you need to look what is the plant realization.
Okay.
I think that's the 2 points are the difference. One is what is the plant realization, and another one is the parity between foundry grade pig iron and the steel grade or basic grade. This export is steel grade or basic grade pig iron and not foundry grade pig iron. And there is a cost differential and price differential of 3,000 rupees. And freight to Punjab is 3,500. I think once you do all this calculation correctly, we get higher X works sales realization for export than sending the pig iron to Punjab.
Okay, so this is margin accretive then, profitability better as well, and it opens up a new opportunity. Would that be fair to say?
Yes, absolutely. Absolutely.
So give us a few details then, sir, in terms of volume growth for this year on pig iron, on casting, as well as on tubes. If you want to give us absolute numbers as well, what could you deliver in this year?
I think with respect to the pig iron volumes, I am still looking for a growth of around 75,000 metric ton of hot metal being produced more, and which amounts to, you can say, about 11 to 12% growth on the volume in pig iron. We are running all the 3 blast furnaces well up running, and we don't expect in near future any stoppage because of the market conditions. Mm-hmm. And coming to the castings, I think the going has been very great. I think demand from tractor industry, auto industry, earth moving equipment, everywhere, I think demand is good. We have to ramp up our outputs and sell more quantities. I think we are catching up with that, and though we could not achieve 15% growth in production and sales last year, we achieved, I think, 14%, and I look forward something like 17-18% increase in the production and sales this year, and the peace in Middle East also should be an encourager for this. And as you know, we have productionized Oliver foundry in Punjab. It has a capacity of realizable capacity of 25,000 metric ton per annum. We are sold out completely on that foundry. We have started producing 2,000 per month and selling 2,000 per month. It's a great encouragement for us, and we have already decided and started the project to double the capacity in Oliver. It will happen by March 27. Immediately within these 10 months, we will double the capacity because we need to serve our customers in the north, and we would not like to lose the opportunity and time. So we are going ahead with the expansion there in Oliver.
And in tubes, how much will you do? So casting will be around what, 190 to 2 lakh tons for this year?
Not 2 lakh tons. I think we are looking more closer to 190. Last year, we increased the volume by 20,000 ton, 19 or 20,000 ton. Okay. This year, I look forward to increase maybe 25,000 ton, which happens to be 17-18% growth.
And you want to give us the tubes number?
Which numbers?
Tubes. You give us...
Yeah. See, always something goes up, something goes down. I think steel also is doing well because demand of auto pulls the steel up. Coming to the tube, I think we did not have a favorable condition in Q1 because of the the delays in the infrastructure projects, delays also export not really doing well because of the many conditions, including the war. I think there is, we will have to see because we have another 10 months to go. I'm looking forward to a revival in the tube business so that we can achieve definitely at least 10% growth in tube as well.
Okay. All right. Mr. Gumaste, you know, you're almost through with this quarter, but give us a brief number. Input costs have gone up, right? Input costs, coke, coal, they've gone up a little bit because of this Middle East crisis as well. So I think that what is the cost escalation that we've seen in Q1 versus Q4? But there's also been a price increase. So what has that been if you could equate the two? And what would it mean in terms of spreads for this quarter in comparison to last?
Basically, I would like that EBITDA margins, etc., to be covered more detail after the quarterly call. But I would like to say that some improvement in the margin in pig iron is taking place because of the price increase, and we have passed on some advantage to the exchange rate and also to coal price. But I think we are still able to improve the margins in pig iron compared to overall last year.
Okay. Final question. You don't want to talk about this quarter, but for the year, if you could give us a guidance. Last year, you did around 850 crores of EBITDA. This year, what could the outlook look like in terms of the EBITDA? And I think CapEx have lined up as around 600 crores for this year. What is your net debt and where does that go? EBITDA and net debt. And then we'll let you go, Mr. Gumaste, and we'll chat up after the quarterly results.
No, I think it's very important to understand what is happening to our green power initiative and drive. We are commissioning 35 megawatts of solar within these couple of months, July, August. We are also commissioning 25 megawatts of wind within these 3 months, June, July, August. So I think this is going to bring the cost advantage surely for the second half, but some partially for the Q2. And I expect a total advantage of at least 40 to 50 crore coming from the additional green power commissioning what we are doing. Our drive on cost reduction in pig iron is also giving some benefit. Definitely, as we are driving both growth as well as the margin improvement. I think not much in our hand with respect to pig iron, but casting, whatever is the price increase, input cost increase, we have arrangement to pass on to the customer. We are also working with the customers to take care of certain other unexpected cost increases like the fuel. Yes. I expect that we should get support, and good market is good for us to improve our margins as well.
Got it, Mr. Gumaste. Thanks a lot for joining in and filling us in with all of those details. Wishing you all the best, and we'll chat up soon.
Thank you very much.
All right, with that, let's move on to the primary issue right now. We have InsurTech platform, Turtleman Fintech, near 900 crore rupee IPO opens for subscription, near 700 crore rupees of that fresh issue, and the rest would be offer for sale. The details of the IPO are for you on the screen. Price band fixed between 144 to 152. Importantly, the company obviously generates most of its income through commissions on sale and renewal of insurance products, on mutual fund products, on credit card products, etc. We do have Dhirendra, along with him is Anand. Both of them, the top management of the company, joining us on the show. Thanks a lot, gentlemen, for joining us in the studios, and good luck. It's an important day. But, just wanted to understand a couple of things. If you could explain to us the rough business of the company in terms of revenue profile. I see about 750 crores in the last 9 months of the financial year in terms of revenue. How much of it is contributed from the insurance bit? How much of it comes from mutual fund, credit card and loans? And how are these, spaced across margins?
Right. So you should think of Turtlement as an insurance business, largely. We have created a granular network of POSPs. They give advice, doorstep advisory to the last mile policyholder, mostly in tier 3, tier 4 market. And that's been the genesis of the business. It's very recently that other alternatives like mutual funds and other products have been added, but 97% plus is an insurance business.
Right. So 97 plus is the insurance business, and that's where a little of the concern is as well, right? Because concentration is always a concern. Add to that, the recent, policy developments that have taken place, Bima Sugam, which is expected to practically remove all commissions or even...
Before that, can we just pull back a little bit and just explain to us a little bit about the business itself? 97% is insurance. Anand, how are you different from, I mean, for our viewers, you are not a policy, but you're not PB, you're not like, the business model is different. They're also insurance distributor, but what you do is different. So just talk to us a little bit about how you're different.
Yeah. So we started out with the mission of taking insurance to the last mile of the country, the remotest parts of the country. And what we realized is that if you wanted to take insurance there, knowledge of insurance is a challenge for people. They don't even think about it. So creating trained manpower is very important, trained advisors basically in these remote areas. And that's how we started out. We focused on creating this trained manpower. Technology was very important. So we built an app that helps these advisors in the small towns and cities in more than 19,000 plus pin codes to deliver the products, all the products, to train them, to also help them with marketing tools. And so that's fundamentally different from a call center based or a fully digital kind of model. We focus on
So can I go to the Turtlemint website and buy a policy? No, I cannot. I can.
You can buy, but the focus of our business model is the advisor enablement, which we do through our Turtlemint Pro app, which is meant for advisors.
So you have feet on the ground. You have people on the ground. And the other big difference, I think, compared to the much larger player in this space, which is Policy Bazaar, is that you operate in tier 3, tier 4 cities.
Yes.
And they are in tier 1. I mean, actually, they're all over. They're much larger. But I'm saying that's a clear differentiation in that sense?
Yeah, 75% of our business comes from the smaller towns and cities. We also are there in the larger cities. But the big thesis of our business has been, the insurance penetration is lower beyond the metros. So we focused on looking beyond the metros. And we built our business model around the opportunity in those areas.
Smaller cities and smaller towns would also mean smaller ticket size of products sold, right? So is that correct?
So I'll just explain the insurance business is slightly different from wealth management business, where it's a business of population, number of people. Unlike in other businesses where, let's say, one person with a high wealth could be, there would be a significant
my only
difference.
point is somebody in Bombay will take a 5 crore policy. Somebody in a smaller town will take a, 20 lakh policy, 25 lakh policy. You as distributors will take a commission of whatever that value is.
Right.
So my point is that a differentiation?
Largely it is B30. Most of the people who are buying are getting introduced to insurance for the first time. So we are expanding the market in the B30 area. And B30 in the last 5 years has started to grow at a rate 50 to 60% higher than the top 30 market, because those markets have been traditionally underpenetrated. And it's very difficult to create a last mile network there because earlier viable models have not existed because technology did not exist. But with Turtlemint Pro coming up with more than 5 million downloads and within 6 lakh plus registered users, they are able to reach through their social network to the last mile people and distribute products and create this new source of income while distributing the product, but also distribute within the social network. So there is a bit of financial well-being involvement where they protect them at the time of not only policy issuance, but also at the time of claim and provide the last mile service. So ticket sizes are different, but it's a volume game. We have issued more than 2 crore plus policies in the DRHP period, and hence this is a large volume business.
2 crore policies up till now.
2 crore policies in the DRHP period, so in about 3.5 year period.
All right. So that still doesn't take away from the risk, right? Commissions is still your main source of income, irrespective of how you're operating versus all the other players. And that's where there is a risk, right? I mean, IRDAI has been looking at capping commissions, or Bima Sugam may take the need away from commissions. So is there an existential risk to a business like yours?
So one primary thesis that we have is consumers, all policyholders need expert advice when they are making a decision. And nobody wakes up thinking that they want to buy an insurance, and hence intent creation is the single most valuable activity in the insurance distribution value chain. We create that intent to the social network of the person without spending any money on creating that intent. So model point of view, it's a transaction model. Second, all the shift towards creating policyholder affordability and driving towards better penetration moves in the right direction, because in OND quarter when GST cuts were implemented, the volumes grew by 70-80%. And that obviously structurally the insurance is a fast growing industry. Within that B30 is fast growing market. So Turtlemint has a significant presence there, and hence it will be a fast growing market. So anything in the direction of policy affordability will help penetrate the market. And under the Insurance for All 2047 mission of the government, it will help.
Because you're in tier 3 and beyond, alongside that your ticket sizes are small. It's a volume game. You have people on the ground, etc. Your costs would obviously be higher than the leader as well. So if the commissions were to come down unilaterally, the impact on your earnings would be a lot more than the others?
It will get offset by the volumes that we will do, one. Second, the tech has been built out. So it's largely tech-led platform. So if you'll see in the last 3-4 years, our tech costs our fixed cost has not gone up, and fixed cost as a ratio has gone down from 42% to 24-25%. So that shows the operating leverage. So higher the volume, better is the operating leverage, economies of scale start playing out. So it will actually be a tailwind because it will move in the direction of driving more policy transactions.
So just give us a couple of numbers then. You've been growing at a phenomenal clip, and as you've been saying that there's a tremendous potential for growth. So on growth, what kind of a run rate should we be looking at? Looking at the previous year was around 50%. And as you said, cost as a percentage of revenue, that's come down from around 45% to around 20 to 23% or thereabouts. So that declining trend does continue. And the focus on profitability, because in a business like yours is very tricky. You have a beautiful ambition. You're looking at big growth, but your shareholders are going to say, where's the money? Where's the profitability? Are we going to be seeing green like you all are wearing right now?
Right. So thank you for that question. So we are in a pre-profitability stage right now. If you look at the KPI that we measure is P3M active. In the past 3 months, how many people have issued a policy? So that has been growing at a CAGR of 55% for the last 8 years, 8-9 years now. And this is driven largely by the fact that the market is growing and structurally we are growing there. So there are two parts there with the way to look at profitability. One is service EBITDA that we measure, which is a key KPI that we've given out. We moved from minus 11% to plus 11%. Second, the platform has been built out. So there is no new incremental large investment that needs to go into the platform. So hence, the fixed cost as a ratio has gone down. So EBITDA as a percentage, negative EBITDA as a percentage is reduced from minus 54% to minus 15%. So we've been adding, in other words, about 100 and 110 crores plus every year for the last 3-4 years. So it is at a pre-profitability stage right now, and it's almost looking like it's converging, and that's the way to think about the path to profitability.
No, just in terms of valuations, right? What is, I think, the overall valuation, and this is great news for investors because, I mean, if the business is good, then they're getting it at a cheaper valuation they would have gotten it 3 years back. Because it was valued, the company was valued at about 6,500 crores.
Right.
And now you're seeking a post-listing market cap of 4,500 crores. Right. This is in the last 3 years. What has changed from 6,500 crores to 4,500 crores?
Yeah. So the way the valuation was arrived at was obviously with the support with our consultants, bankers, and the overall feedback that we got. We have a 75% QIB book. The valuation has been designed for all categories and all sets of investors to come in. It's a fast-growing market. It's a large growing
so
sort of
valuation
industry.
should go up, not down. What has changed is the question.
So it has been designed basis the feedback, and also
Is it a function of your business? Is it a function of market conditions? What is it?
so there has also been a market resetting that happened between 22 because we were in the 22 when there was a different phase. We are in now 26, so there was always been a market resetting also.
Is that why you reduced the size of the IPO as well?
So our existing investors continue to be long-term committed. They have been with us in the trenches. They have also supported us, mentored us as the board. They think of this business as a large opportunity going forward. So they have decided not to sell significantly, hardly 3-4%.
Or not to sell at this valuation and maybe sell it when it reaches 6,500 crore post-listing at some point.
So they believe in the India story and they believe in the insurance story. So anybody who is looking at who thinks of insurance as a long-term large growth opportunity, then structurally this offers a great opportunity.
Well, gentlemen, we appreciate you coming down.
Sorry, just one more thing. We will get the distribution reforms shortly. I think we had the IRDAI chairman, and Bima Sugam is one thing,
Right.
but I think there is comprehensive distribution reforms also coming in over the next, I think, 1 week or so. Do you see that as is that a threat per se? I mean, because it directly addresses distribution. I mean, distribution commissions, etc. So, just wanted your thoughts there.
Like I was mentioning earlier, anything that moves in the direction of improving policy, because the regulator is working towards policyholder protection.
That is not an answer. I'm looking for that is, more volumes, but I'm saying it directly impacts what you make now. So will that squeeze margins for you?
So in the O&D quarter, we have seen that one example where due to GST reduction, the commissions were reduced, but absolute value grew for us by almost 80% on those categories where the product commission were reduced. And margins also improved because the better volume scale level commissions was received by us. So we see it as an opportunity. We see it as a tailwind. Our business has been built on the tailwinds of the regulatory changes that happened. POSP regulation did not exist.
I'm just insisting because, I would be remiss not to ask you that because it is imminent. We had, as I said, we had the chairman.
Yeah, we are closely looking
I think we should have that in the next 5 days, basically.
I just want to add one point, right? I mean, we have built out the platform. We built out a very large network. So we are quite confident we are the lowest cost distributor
Got it.
in the country.
So the others
And-
would get impacted a lot more before
Yeah, so
you.
we should benefit if there is, there should
Got
be a
it.
movement towards the lowest cost producer here. So.
And just to wrap this up, you've also, begun your diversification journey. 97% is still insurance. The other 3% is other products. Do you focus a little more on that as well? Do you have a target on how much do you want from outside of insurance? Because this is the one thing that a lot of these fintech and, the new age companies are looking at. They're looking at cross-selling and they're looking at opportunities of multiple products selling on the same platform.
Yeah, we have that. We have a great opportunity. So network is built out. The same customer that has bought insurance from us also wants loans, wants mutual funds, and we are enabling these products through our network. So it's a big opportunity.
Well, I think you're 1/10 the size of the larger competitor, so there is lots of room to grow. That's the way I would look at it. Wish you all the best of luck, gentlemen, as you kickstart the IPO process, and we will talk more specific numbers as far as the quarterly numbers, etc. go. So, thank you very much once again. That's Turtle Mint, in the insurance distribution space, with a conversation around what they aim to do, and of course, sounding pretty bullish about prospects. Just the sheer volume should take care of any squeeze as far as margins and commission, etc. go. We'll take a break. We're back. Manisha Gupta focuses on commodities on the other side. Stay tuned.
Is largely symbolic.
प्लांच की वर्ल्ड रेनाउंड टेक्नोलॉजी देती है स्टील को ज्यादा ताकत हर बार। अंबा शक्ति SDTMT।
Okay, welcome back. Manisha is here with Commodities in Focus. Manisha, morning.
Morning, Prashant. Thank you for that. Well, I'm looking at the monsoons right now, and every day that passes in the month of June, you're looking at the deficiencies just about increasing. So when you look at the 1st of June to 18th of June, the monsoon in India is now 40% below normal. It has been a late onset. It's an El Nino year as well. But the kind of numbers that we're looking at on the weaker side, the IMD and various other forecasters believe that it's going to be difficult for India to pick up these numbers therein. So when I look at the various geographies herein, and as you can see, the biggest of deficiencies clearly coming in for the central part of India. Now, this is your bread bowl as well. This is where cereals and most of the kharif crops are grown. And then you have East and Northeast India looking at 46% of deficiency, 20% of a decline in rainfall is what South Peninsula is facing. Northwest better at just about 2% of a decline there. But when I take you through the kind of states that are looking at deficiencies is really large. So number of states that have seen deficiency anywhere between 20 to 30% are 3. 6 states are dealing with deficiencies between 30 to 40%. And you have 4 states also looking at deficiencies anywhere between 40 to 50%. And a state that is looking at a deficiency almost at 60%. And when you look at deficiencies almost at 50 to 60%, those are called as large deficiencies. And there are very many states within this category as well. You have Meghalaya looking at 86% of deficiency in sense of rainfall. Gujarat at 79%, Maharashtra 78%, Jharkhand 70%. You also have Goa, Chhattisgarh, which are also looking at anywhere between 60 to 68% of a deficiency there. So when you look at overall India, a large excess number is only at just about 8%. You have excess rainfall in some places as well. It constitutes to around 7% of India. Normal rainfall is at just about 18%. And now comes on your screen the deficiencies and the large deficiencies and no rains at all. And this comprises of nearly 67% of India, which has seen deficiency and large deficiency therein. You might say that this is just about June and we still have another 3.5 months to go when it is about rainfall. But the concerns clearly are in the number here. Remember, it's an El Nino year, and many people are calling it a super El Nino, enormous El Nino, etc. I'll tell you what El Nino is all about. This is about unusual warming of surface waters in central and eastern tropical Pacific Ocean. Now, when you look at the overall state that we are in right now, well, the temperature departure from the sea surface from long-term average temperature and the severity of that is what El Nino really means about. What it also brings with it is leads to weak trade winds and also moisture diversion. And when you look at the overall numbers, and this is as per the IMD data, so what IMD says is that in the month of June, it's going to be a weak El Nino, which means 0.5 to 1.01 degrees Celsius of a diversion in sense of the sea temperature there. IMD also says that by the time we are in case of July and August, it's going to be a moderate El Nino. That means that the diversion is going to even be higher from 1 to 1.5%. IMD then goes on to say that by the time it is September, the diversion is going to be 1.5 to more than 2%. There are certain reports talking about 2.5 to 3 as well. And 2.5 onwards is severe El Nino, which perhaps we are looking at in this year. So is the concern really coming in? Even as we are trading with weak El Nino for the month of June, we already are facing a 40% of a decline in monsoon. Going forward is going to be a stronger El Nino, and that is where the concern comes in for July and August and September. And then there are reports also suggesting that the ways El Nino is transforming, it could perhaps be the weakest year in 2027 as well. That could impact the Rabi crop as well. So not just Kharif, but Rabi as well is under slight threat right now.
All right. Well, we'll have to watch this all closely, but it's extremely important, not just for agriculture, but for industry as well, as we've learned recently, earlier this week, with those water cuts for real estate, industrial use, etc., etc. So, important one. We'll take a break. We are back, and Lata will be in conversation with Lionel Johnson of Pacific Pension and Investment Institute and Arvind Chari of Q India on Foreign Fund View on the markets. Now, stay tuned. Coming up.
Welcome to a special markets and macros discussion. Even as the fall in crude prices gave us hope, as Indians that is, hopes of a return of foreign funds, the less than expected earnings of Accenture has led to a fresh coat of red paint on Indian shares. Has the foreign investor perception of Indian assets changed at all after the stabilization of the rupee and the seeming end of the Iran war? To understand the FPI psyche, the foreign fund psyche, I have with me a very special guest, Lionel Johnson, President of the Pacific Pension and Investment Institute, a global forum for long-term institutional investors. Also with him is Arvind Chari, the CIO of Q India, a well-known face. Q India, of course, is a group entity of Quantum Advisors. Arvind, Lionel, thank you very much for dropping into our studios.
Glad to be with you.
Okay, Lionel, first, if you can tell us, what exactly is PPI? It's not very well known over here. Who are your members? I mean, whom can you influence?
Well, thank you for the opportunity to be with you. And the Pacific Pension and Investment Institute, or PPI, is a global membership organization of institutional investors. Global pension funds, endowments, sovereign wealth funds that invest globally. And we have membership from North America, Europe, across Asia. And we bring the leaders together periodically to look at the issues that impact their investment decision-making as it relates to the Asia region. And we have a long relationship with India. We were here with our full delegation in 2017, where we met with the Prime Minister and the Finance Minister and had a very robust discussion here in Mumbai. And it's been almost a decade, and I think it's important now for us to refresh the appreciation.
You're bringing your members again.
We'll be here in October for a full week, and it's time for a fresh look at what's happening here.
Okay, I assume you already went to Delhi and met people in this visit as well. Are you getting a sense? I mean, what are your members telling you? India has gone all out to woo foreign investors. We've taken out the withholding tax and capital gains tax on debt investments into government securities, and there are other things. Subcategories have been removed. Has this cut ice with your members?
Yes, I think so. And I think it's just as important, however, for them to come. I can go back, and I will go back, and enthusiastically encourage them to participate in our delegation. But I think it's really important for them to come to see what the government has done in the last several years to improve the investment environment for investors like ours, long-term investors who have a horizon of quite a few years.
Yes, I guess decades, as you pointed out.
That's right.
But what is the perception you've got so far? I mean, obviously, the numbers are telling us that people are walking out. Year to date, 2026 itself, there has been about $26 billion of money that has flowed out of India. We're not used to it. Typically, we are used to a surfeit of inflows. Are you getting a sense that there is a return? Are you getting a sense that even longer-term investors are waiting for some kind of a growth story?
So this investment that you just alluded to, I think, was more on the short-term investor side, not the institutional investors. We have several members from Canada and Australia that continue to be in this market. They have not adjusted their positions at all. And again, going back to that long-term perspective that they have, there's a lot of volatility that we've seen, and the U.S. and Israeli war with Iran was a big part of that. But the institutional investor has stayed put, and I think that is a big difference that we want to mention.
Okay, so let me come to the medium and the short term as well. Arvind, what is the sense you're getting with the changed rules after the June 5th policy of the Reserve Bank? Is there any igniting of interest?
So I can just add on to what Lionel was saying. So Quantum has been a very long-term member of PPI.
Of the PPI.
And as you know, I've written very elaborately about this, about the fact that global institutional investors are so underallocated to India. Like I put out a note where if you look at the global AUM that is available, India gets less than 1% of that global allocation. And India's weight in the global GDP is 3.5%. India's weight in global market cap, now it's come down, but it's still about 3.5%. So India is very significantly underallocated in global portfolios. Part of the reason for that is many investors, when they invest in India, they do it from a global lens, so like a global fund or a global emerging market allocation or an Asia allocation, and then in India is a weight on that. And unfortunately, MSCI is not only a performance benchmark, it also becomes an allocation guidance. So people will look, I want to be overweight India or underweight India, given the weight that is already there, right? Only when investors start looking at dedicated allocations, and Lionel mentioned that Canadian pensions, some of them have offices in India, which means they've taken a dedicated choice that I want to be part of the long-term story. I want to understand the risks first. So I want to send my team, do my research, and get the opportunity. And that's been our effort with PPI as well, saying that, come to India, and PPI's membership is global. So, and it is also very high level. So CEOs, CIOs of these pensions and asset owners, they come and attend. And the idea is when they spend a week, they hear good things, bad things, normal things, and they go back.
I got that. I'm just asking you whether there is a return of interest after the events of the last 2 weeks.
So, so we've had a pressure on the currency, and it's not only from the West Asia. We've had it before that because we've seen outflows from both foreign portfolio investors, which has been concerning, but also from the foreign direct investor, which is good because when you return capital back to LPs, as they call limited partners, they will then reinvest that capital. So that's a good way that India didn't stop those money. But if I look at cumulative flows from foreign investors in equities since 2018, and I'm saying 2018 because that's when capital gains tax was reintroduced in India. It's negative. 7-8 years of negative, effective cumulative negative flows, and that's concerning. What we've tried now is on the bond side. Again, the 20% withholding tax on government bonds should not have been there. Lata, we've been talking about India's inclusion in bond index, and when it actually happened, we increased the tax. So they have done that, which is good. The FCNR, which is a very time-tested approach by us, is whenever we have a currency, I won't say crisis, currency issue, we tap the NRIs and we get money. Looks like we're going to get sizable amount of $40-50 billion of flows. And if we get included in the government, the Bloomberg.
But what are the
Global
chances?
Act,
Are you hearing that there is a?
It seems in this week when I spoke to policymakers, I think the intention was very clear that we reduce it. That was one of the threshold pain points for the inclusion, and we hope to get included. Of course, we know that the time of even if we get included, the eventual inclusion will happen over 18-24 month period. So it will improve sentiment in the sense that the currency depreciation fear, and if we actually get $50-80 billion, which is what everybody is talking about, then it settles the current account deficit issue that we would have had this year if oil would have stayed at $95, $100.
No, actually now the math is working to a BOP surplus. There's no two ways about it.
Absolutely.
You may dispute whether it is a 5 billion surplus or a 50 billion surplus. Because that can vary, but it's clearly a surplus given the amount of money.
Yeah, but on the sentiment side, we would have still wanted that to happen, the capital gains tax reduction to happen on the equity side, because that's where your long-term capital comes in. In bonds, you get it, but if you remember, Rata, in 2013, the initial depreciation of the rupee in May and June happened because of bond outflows. It was selling by European prop foreign banks, which actually depreciated the currency. So bonds can be risky. Like if there is outflow out of EM.
At the moment, we don't believe that. They have been more sticky.
Correct.
It's the equity guys who have been...
And that's the reason, right? If you look at 2024, September 2024 was when markets peaked. And since then, we've seen outflows. And that's the reason, right? There are valuations in India were expensive, relative and in absolute terms.
No, we know the reasons.
Yeah.
I want to know whether any sentiment is changing on the margin.
So I think if we get back that nominal GDP growth back to that 10, 11, 12%, which seems to be happening. I think it was happening before, but for the West Asia crisis, we could see GST cut, income tax cut. We could see the, almost 1% of GDP of direct cash transfers to women across all states. These were all, if you could see sentiment indices were going up. And you could see private capex. I like the way I look at private capex. September and December quarter, for the first 2 quarters of double-digit YOY since 2012. So you could see some aspects, and then this war happened, and now maybe as it's clearing out, the earnings trajectory has to come back to that double-digit. Because what is India's story? India's story is that India has very good companies.
Actually, yesterday we got the direct tax collections. It's 15% higher, way above the nominal GDP as well. So it looks good. Lionel, what is the sense you have heard from your cohort?
From my cohort, I think...
Are they believing that the growth story is back?
I think it's a consensus that it's moving in the right direction. The policy environment is making that possible. And what I heard in Delhi at the beginning of my trip was reassuring along those lines. And so my goal is to go back and convey that to our membership. I will, just as a coincidence, be speaking in a couple of weeks before the board of directors of the California Public Employees Retirement System. It's the largest pension fund in the U.S., and that will be my message. And I will encourage those trustees to join our group. Okay. Many of them did come years ago, but there are a number of new members that I think would like to be engaged in the understanding India and thinking about the investment possibilities.
Has anyone told you about, this may not be your core concern, that India's inclusion in the Bloomberg bond index is likely? I mean, we have ticked most of the boxes except Euroclear. So have you heard anything?
I have not heard anything directly about that.
Have you, Arvind?
Not directly in the last week. Yeah. But I've been involved in this for a long time, and there is a sense that we will get included.
Okay, just a final question. Yeah. Kevin Walsh seems to sound that there is at least no cut. Yeah. Does that alter the funds, or does that make Indian US exceptionalism even stronger?
Interesting to say. I mean, like from a near-term allocation perspective, if you've seen people who have diversified away from the US have actually lost out, because US has done so well. But from a allocation perspective, if you really want to diversify away from the US, actually India has actually the best aspect, biggest market, big market, absorptive capacity, very diversified. Look at the other EM indices; they are so concentrated. India is actually diversified. If you get that growth back, which is our normal story, I think you should get a lot of capital flowing into India if we get things right. And capital gains tax is actually a very big hindrance because it increases the threshold rate of return that you need to be allocating to India.
No, I completely agree. Even if you're making rupee gains, you're making dollar losses, and you were still paying a capital gains tax. I think you're part of that. We hope the government is listening, and of course, Lionel is going to come back with a lot of investors in October. We'll catch up at that time. Thank you very much, Arvind and Lionel, for dropping into our studios.
Thank you so much.
Well, that's discussion as close as you can get from foreign investors. We wrap up on Bazaar. Chartbusters coming up after a break.
So while there are headwinds,
Global IT bellwether Accenture trims upper end of revenue guidance, citing weakness in West Asia business. Sentiment spills over onto Indian IT stocks as well, reinforcing concerns around recovery in tech spends. The IT index down 5.5%, multiple stocks down over that.
Amber Enterprises steps up its presence in the smartphone manufacturing. The company inks a collaboration agreement with Oppo India. Amber will manufacture domestic volumes for Oppo, OnePlus and Realme brands. The stock kickstarts green in trade, though it's come off the day's high.
Auto win boost for Viatech Wabag. The company secures a seawater osmosis project in Kuwait worth nearly $150 million to be completed over the next 3 years.
Oro Pharma to divest 4 generic products in order to complete a $250 million acquisition of US-based Lynette. Impact of divested products seen between $4 to around $5 million. Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see, the market's in the red. We've got the tech index that's dragging today, but we've got a very exciting Chartbusters lined up for you with 2 interesting managements. Mangalam, let's get straight to the action.
Let's get straight to the action. But, you know, your portfolios would feel a lot better in today's trading session, largely because just as we speak, the number of green stocks have crossed the red one. So the crisscross lines come up for you. And this notwithstanding the 200-point decline that we're seeing on the Nifty. So 1,500 stocks in the green for about 1,400 in the red. And a few of them that really stand out. We've been talking about how New India Assurance is one of those who are selling stake in the NSE IPO. That stock up now 6% right now after a gain that we saw yesterday as well. The one that's really taking your breath away is Berger Paints, up 8.5%. Now, typically, you don't see paint stocks see this kind of moves on the upside. But for Berger Paints, there is a double engine. One on the lower, and the crude prices are lower. And these companies have taken their price hikes already. So they're covered for margin. And Berger Paints has a large presence in West Bengal. So, you know, it's also a play on the revival in West Bengal post the elections out there. So those 2 factors working for Berger Paints, that stock up 9%. But speaking about the retail space, the retail area, and how consumer sentiment is, let's go across to Premchand Devarakonda, who's the CFO of Electronics Mart, joining us now. The stock obviously has been a buzz all through this week, up around 13% this week itself. And we'll obviously discuss AC sales due to the extended summer, post-war microwave and induction cooktop sales, along with the outlook that the company has on their NCR store expansion and sales. Thanks a lot, Mr. Devarakonda, for joining in. And, I have to ask you about sales of ACs and coolers, because while we're keeping an eye out on the sky, the monsoon's still not here, and temperatures soaring across the country. Has that meant increased AC sales for you? How much do they typically account for in your overall sales, and how has that grown this year? Obviously, well on last year's low base.
Yeah, good morning, and thank you very much for the opportunity. See, this summer was very good in terms of the AC sale because the temperatures are soaring. And we cannot compare to the last year's performance because last year's summer season was washed out totally, which was, now that's why we are comparing to the earlier year's AC sale. Definitely there was impressive growth in air conditioner sales, and it is still continuing. Even in the month of June, there are little bit of demand for air conditioners. It is continuing, and it is definitely a positive sign for the air conditioner industry.
Could you tell us how much in your overall sales do ACs contribute? And as compared to an average year, not last year, but an average summer year, how much more has this year been?
Yeah, see, historically, our AC contribution was about 12% to the top line. But this year, we are expecting much better, like it might go up to 15%, we're looking at the current trends. And definitely that air conditioner sale will add to the bottom line.
Okay, all right. The other interesting part of the business is the induction cooktops as well as microwaves, right? How much is that as a percentage of your mix? AC, you said 12 goes to 15%. Induction cooktops as well as microwaves is how much, and where does that number head to?
In our case, the induction cooktops and microwave is okay. It's about 1 to 2%. And induction cooktops contribution is negligible. This year, actually during the month of March, definitely there was little pent-up demand for the induction cooktops, but now it is slowed down. But microwave is definitely doing very well. That in terms of the absolute terms, that contribution is not significant in our case.
All right, contribution is not significant, but what's a good insight is the fact that after the spike that you saw in the month of March, April, now these sales have cooled off. Have they cooled off from the peak and are still higher from normal levels? What we're trying to understand is the demand elevated and sustained after the peak, coming off?
No, it didn't sustain. It was temporary for a couple of weeks. Later on, it is full.
All right, no, because these things will have a bearing on all the other listed companies who make induction cooktops and sell, microwaves, etc. as well. On the same store sales growth, because ACs are doing well and you saw good sales in the summer months, how has same store sales growth panned out in the first quarter and what are you projecting for the full year?
The full year SSG would be around the high single digits, looking at the current trends. But in the first quarter, definitely it is much better because the base was very low. So we are expecting around, I think it's above 15% for the first quarter.
All right, 15% SSSG for the first quarter and full year you said was what?
High single digit.
High single digit, all right. And what about margins? I mean, a lot of the companies have gone ahead and increased prices. You would be sitting on some of the older inventory, etc. as well. Your own operating costs have increased as well, plus a higher contribution coming in from NCR stores now. So all these factors, how should one look at margins this year?
See, last year we were around 6% EBITDA margin. So this year definitely there will be significant growth. That means that at least 50 bips improvement will be there in EBITDA at the company level because NCR stabilized and South is already for Q1 there was decent growth across all categories. So we can expect above 6.5% this year.
All right, 6.5% this year. On NCR, what's your store expansion plan over the next couple of years? And while realizations per store are a lot higher in NCR once the penetration increases, competition is high as well, which means the margins are lower in NCR stores versus what you have in the South. So when do these normalize?
This will take further at least 2 more years because even if the NCR stores mature, so we may not expect the similar EBITDA contribution, store level EBITDA contribution from NCR. So Southern cluster will, if Southern cluster contributes say 6.5% to 7%, so EBITDA margins, North cluster will be at least lower than South cluster, even after the store mature. And it will take 2 more years to reach to this level. For the next couple of years, we are focusing on, there will be organic store addition in existing clusters like AP, Telangana and NCR. And we are currently looking at the eastern markets, Eastern Indian markets, where we'll have the base at Kolkata, and from there we start expanding to the eastern part of India.
Oh, so you're looking at the eastern part of the country as well. What is your target here, say 3 to 5 years from now? And, that also means further investments. So the margins, I think, would be capped at around 6.5%, 7% for the foreseeable future for you. And most of the growth will come in from revenue and new stores itself.
This system market, currently what happened, like NCR is on track, now it is stabilized. Now we are going to expand to the new territories where we will have initial burn, but it will not be as significant as NCR because in NCR we had to invest heavy in the initial years in acquiring the real estate, real estates over there. So that will not be the scenario in Calcutta market. So that's why it will not be as the burn will not be as much as that we incurred in NCR market.
Okay, very quickly, overall revenue growth for the year?
Please say it again.
What should the overall revenue growth for the year look like?
Yeah, we are targeting 15% top line growth this year.
15% growth. Well, sir, we appreciate you joining and wishing you all the best. For the time being, the street likes what you've said. The stock has moved to the high point of the day. We'll track you at all these numbers. But for the time being, I think the street is taking a note of what you just said. All the best for the remainder of this quarter. For the time being, we slip into a short break. Come back. We'll get you more on the markets and stock-specific action.
The thing Iran most
Welcome back. You're tuned in to Chartbusters. You're on CNBC TV 18. Well, the markets are down close to around 200 points, but from the broader market, there are a fair bit of stocks that are moving around. Lloyd Engineering Works, well, they announced that deal yesterday with regard to the acquisition. Well, that stock was down close to around 5% this morning. That's pulled back some of the losses. Now it's moved into the green. The other one is JTL. Just pull up that stock. It was at around 72 bucks earlier today. I saw a large trade that took place. It'll be interesting to see who exactly was part of that deal. JTL should come up for you on the screen. Massive volumes out there. In all probability, going by the volumes, there should be a disclosure because that one as well has spiked up. So that comes up for you on the screen. DCX, that's the other stock, the defense company, big underperformer. That as well is moving higher actually on rather large volumes. Now up close to around 6.5% or thereabouts.
We're seeing also some traction in a bunch of these defense names. Paras Defense hit a fresh high just a few sessions ago and back again. It's up nearly about 7.5%. And the hospitality space, that has been a buzz as well. This morning, we're seeing some traction in Leela Palaces and Hotels as well. It's been a decent week for them, up around 12% for the stock, 5.5% right now for Leela Palaces. In fact, over the last 10 days or so, we've been getting a lot of commentary from the hospitality industry saying that the first quarter is not as bad as they feared it to be. And we heard from Indian hotels, we heard from Chalet Hotels. Let's bring in another hospitality company as well. Ashish Jakhanwala, who's the founder, chairman, managing director of Sami Hotels, now joins us. Ashish, you're one of the few who actually quantified the impact of the fourth quarter, the West Asia crisis of the fourth quarter, to the tune of about 20 to 22 crores in your overall numbers. A large part of the impact was actually felt in the first quarter as well. Could you give us a sense on how the first quarter has been? Q4 saw some parts of the impact, Q1 had more of it, but then again, you had a favorable base as well, because same time last year, we had, Operation Sindoor and all those events, unfortunate events that took place. So to that extent, how has Q1 panned out for you, and what are you projecting for the full year?
Thank you. So you're absolutely right. I think we need to be very cautious about when we look at numbers this year, because last year there were multiple interruptions, Sindoor, then the Indigo crisis, then the West Asia crisis in March. So to that extent, YOY becomes a little misleading. But I think one key metrics that I would draw our attention to is the capacity utilization or the occupancy level. So since the crisis started, which is, let's assume that was March. So March, April, May, we saw an occupancy of almost 75.6% across our portfolio, which was up from about 73.5% same 3 months last year. So we've clearly seen a really good uptake in the demand. The rate growth was not as high as we have been used to, because a lot of this demand originated from domestic sources, and the pricing power was slightly less than it is typically in a normal business. June actually is very strong, and that's a good sign that we are seeing the impact of the West Asia crisis tapering off, and the occupancies are almost touching now 80%, at least in our portfolio.
All right, occupancy is turning, touching almost 80%. But that's an interesting point that you're making, that rate increases weren't as much because largely the demand was domestic, and that is contrary to what everyone else was earlier believing. Crisis or no crisis, everyone thought that maybe rate increases will continue because the domestic tourist has started to learn to pay more as well. But we take that point on board. I just wanted to understand, in the very recent past and the very near future, what proportion of your revenue does come in from Mumbai and the MMR region, largely because there has been that water supply issue as well. Have they caused any sort of operational hassles for you?
So we don't have any inventory in Mumbai as of now. We are developing a large Westin and Fairfield in Navi Mumbai, but that's a few years away. So I wouldn't be able to comment on that, really.
All right. And for the full year, what are you targeting when it comes to RevPAR? Because
I think the full year guidance is pretty strong, because we've seen a solid recovery in June, both in occupancy and rates. And therefore, we think that we will hold on to a double-digit total revenue growth for the full year, in spite of the fact that starting 2 months, which is April and May, were not really good. So I think the recovery is pretty encouraging. And whatever business we see on books, the pace that we see, remain fairly confident that it should be a double-digit total revenue growth.
Okay, all right. Hi, Ashish. Good to see you in. What about Rare? What's the scale-up plan out there? What are you penciling in terms of revenue numbers for this year and the next?
So Rare is moving well on 2 counts. One is obviously the portfolio growth. So we've obviously seen 4 or 5 new hotels adding to that portfolio. So now it's about a 71 hotel portfolio. The second, which is actually even more important for us, is how the Marriott integration is going to pan out. And we do expect that the first few hotels would get integrated with Marriott by 1st October, which is when we'll start seeing the revenues start for Rare, actually. So I think FY28 is when we'll see the real benefit of Rare, at which point we should start seeing the revenues grow substantially.
All right. So the 90 to 100 crore target comes in for FY28, right?
FY29.
FY29. And, I just wanted to understand, I was listening into your, or reading into your conference call transcript as well. And you've projected, 3,000 crores of free cash flow accretion over the next 4 years?
That's right, Mangla.
And what do you do with that? Largely because, you got to reinvest at some point in time, keep expanding. And I'm looking at your current market cap, that close to 4,000 crores. Compare that to the 3,000 crore cash flow that you're projecting. If you're doing DCF, etc., and you're a master at that because you've been, selling companies to private equity players, etc. So is more likely to come in the form of institutional interest, PE interest?
So you're absolutely right. I think we're in a I keep telling my team we're in a Goldilocks zone right now. We're in a good cycle. The balance sheet is very healthy. Every single year we're producing more cash than we can consume. And the only thing it does for a management team is really create optionality. So if you look at our Q4 presentation, we've clearly said, we are steadfast focused on leverage and we need to bring it down to around 2.5 times net debt to EBITDA. That seems like an easy task right now. So I wouldn't really worry about it. Second is we have about 2,200 crores of funded capex. And that capex really helps us build our revenue base from current 1,200 crores to almost 3,000 crores over the next 5 years. So we have the capex coming our way to take the company from 1,200 crores to almost 3,000 crores of total revenue. Third is we keep looking at some M&A opportunities as and when they come to us. And last but not the least, the board at the right time will really take a call if there is some residual capital available for shareholder return. But I think it's a little early for that.
But is there some inorganic growth we should look forward to sometime in 2026? Something on the anvil?
Yeah, I think, we are very opportunistic on that, really. I don't think we give ourselves a target to buy a hotel. To that extent, we are fairly opportunistic. When we see the right opportunity with the right set of returns, we will act. And as I said earlier, we have the financial flexibility to do so. We have some interesting pipeline, but deals in India, I always tell people that deal volume in India is very high. Deal velocity is always the problem.
Yeah, it's interesting because you've also said that you're into refurbishing capital. You're not into, just deploying capex or raising funds because you trade your old hotels to go ahead and buy new hotels. Old hotels you're selling at multiples higher than what your current company is trading at. So how will you then buy hotels which are at a higher multiple then?
Don't make it sound like our business that we sell hotels to buy hotels. We take it as a fiduciary responsibility to recycle capital once in a while. We have to extract capital from assets which don't create long-term shareholder value. And we clearly need to deploy that capital in assets which do create long-term shareholder value. But listen, it's not our business. We don't do it every time. We probably do it once in 18 months or so. But that aside, that creates a bigger optionality, honestly. But I think, as I said earlier, we have a fair bit of growth that we've already invested in. The assets that we are currently developing, which is the W in Hyderabad, which opens next year. We have Westin in Bangalore, which opens in, let's say, 2030. We have the development we have done with IKEA in Noida. We have the big development in Navi Mumbai. Put all of this together and take last year RevPAR, and you'll really solve for about 2.5 to 3,000 crores top line for SEMI. And that's a fair bit of growth for me and my team to deliver over the next 4 years. So that's really where we are focused. But again, I'll repeat that we are an opportunistic investor and a buyer. Whenever we see the right opportunity, we will not waste time.
Well, Ashish, you seem like that kind of a customer who's gone to a hotel and not just expecting the breakfast, with the room. You're talking about lunch as well as dinner, looking at the ideal mix on a lighter note. Well, thanks a lot.
That's not all. An all-you-can-eat meal, even in the breakfast, lunch and dinner, the buffet.
You know what I'm most excited about, Red Mangalam? The sundown happy hours. That's special. That's where I make an impact. All right, Ashish, thanks a lot for joining in. Have a good Friday. We catch up soon. Appreciate you giving us all that guidance. Well, time to slip into a short break. On the other side, we'll get back to the market stock-specific action as well.
Well, we've come to the end of this edition of Chartbusters. All the top 4 indices currently lower. We have about 220 points on the Nifty, which have been shaved off. The Nifty Bank actually seeing a fresh bout of selling along with the IT pack, which has already been pressurizing the market. That explains why the Nifty is holding at the lower end of today's trading range so far. But what we do is take your leave and leave it to the team of Trading Hour to take all the market action forward. Thank you for watching.
Democrats.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. Joining me as always is Ritu Singh. Ritu, good morning. Well, after gaining for every single day this week, the markets are taking a bit of a breather for obvious reasons as such. And of course, the fact that we are counting down to a very big event, and that is the AGM of Reliance Industries in just a couple of hours from now, starting 2 p.m. A lot of clarity awaited on a lot of subjects. And and that will also have a bearing on how the market would also fare in the last hour of the trading session. Reliance has given up most of its gains from earlier in the day, is now down to the lows of the day, is now moved into the red, and that too has had a bearing on the index, now 225 points lower as we speak for the markets. But for what has been a fairly good week, you can call this profit booking at higher levels, and that too because of sector specific issues, Ritu.
That's right. Good morning, Hormaz. And one of that sectors that Hormaz is referring to, of course, is IT. That's the culprit today, dragging the frontline index lower, seeing quite a bit of pain down, almost 5.6%. The IT index leading that loss is Infosys, the top dragger for the Nifty. Other draggers, HDFC Bank, TCS, HCL, Tech Mahindra, all of them exerting a downward pressure. What's helping on the other side is names like Airtel, Bajaj Finance, ICICI Bank, and NTPC. Reliance is the heavyweight. We have to see if that reacts after its AGM that is scheduled for later today. So all eyes to what is announced there. But as far as the market breadth is concerned, those lines were crisscrossing earlier. Now you have more stocks that are declining than they're advancing. And the India VIX shows you that's a 5.6% spike that we're seeing today about the mood of the market. But let's get focusing on that big story of the day, and that is IT stocks. They've slipped after global IT bellwether Accenture trimmed the upper end of its revenue guidance, citing weakness in West Asia business. Vinny Motiwala joins us now for more on this big story. Vinny, take us through what's happening in the IT pack today.
Hi, good morning. So firstly, obviously, let's talk about Accenture, right? What happened over there? Revenues, they rose by around 5.6%. But what came in was, it was a miss versus what the street was expecting. EPS, again, it came in at $3.8 versus $3.49 on a year-on-year basis, which was a growth. That was in line with expectations. Bookings saw a fall of 2%. So there was a bit of a slight muted performance that came in from Accenture. But what was the highlight was the outlook for FY26, right? They narrowed their FY26 revenue growth view to 3 to 4%. Previously, the guidance was 3 to 5%. So on the top end of the guidance, they've lowered it. And that is a concern in terms of CC growth. This is including that Federal Reserve impact that they are talking about as well. While in terms of EPS, they have adjusted it and raised the EPS target as well. FY26 outlook for cash flows, that continues to be positive. Free cash flow continues to be positive. In the con call, what they highlighted, that client budgets, that seemed to be a concern, right? They have not been increasing even with AI and with spendings being redeployed rather than expanding. Though they still said that AI engagements, they continue to see an increase in terms of average size. But there is a bit of a control that comes in on discretionary spends of clients. There is a bit of a delay that's coming in decision making as well. And overall, the company is expecting a 1% impact of that federal business and 1.5% impact of the inorganic contribution as well. They've also highlighted some impact because of the Middle East region as well. So that is something that could impact them in the next 1-2 quarters. The read-through for Indian IT companies a bit muted. We're seeing that negative cut in guidance is a bit of a negative that comes in for Indian companies. Large managed service opportunities, which are now moving to FY27, indicates that maybe Indian IT companies also could see a bit of a muted performance in terms of booking trends. Sales in Middle East, that could come in as a concern for us in the next 1-2 quarters as well. And that is why we're seeing red on the screen for IT companies.
Vinny, stay on for more on, what the view for India is and the way ahead. We've had a whole host of brokerages that have also come out with their views in the space. Tell us what the likes of CLSA, HSBC, Nomura, Jefferies, all of them are saying.
Absolutely. So let's talk about CLSA, right? They believe that this guidance cut that's come in, the soft managed service order book, which is a bit muted. Yes, that has all got to do with more in terms of the negative macro environment rather than the AI impact. They're saying the increase in headcount that Accenture has seen, that's surely an encouraging sign, and believe that the sector is still alive. A lot of opportunities are still there, and the companies which are more exposed to discretionary demand, like Infosys and Wipro, maybe will see a bit more impact versus other players who are focusing more on cost optimization, like HCL Tech. So they worry that Infosys and Wipro maybe could see a bigger impact. HSBC, they are saying that Indian IT service companies will continue to see the short-term positive triggers coming in for them, and valuations, though, are not too high, but that is something that they're keeping an eye out on. Nomura also, they said that they prefer Infosys and Cognizant in the large cap and Coforge as well as eClerx in the mid and small cap side. Jefferies on the IT pack, they said that despite this 25% fall on a YTD basis, they're still maintaining that underperform rating and underweight rating on this, and they believe that maybe Indian IT service companies could see some bit more of a pressure given that AI side has not picked up as one was expecting it to. When you look at it in terms of the Nifty IT index as well, we have seen a sharp fall coming in, whether 1 year, 1 month, or even a YTD performance, we have seen a sharp fall. Valuations obviously are much below those peak valuations, which were seen last couple of years back, 24, 25. That's the only time we saw these peak valuations, and then we've just seen a decline coming in. So far, no recovery that has come in for Indian IT service companies.
7 out of the top 10 losers on the Nifty 500 are IT names. Winnie, thank you for summarizing that for us. Well, Infosys, TCS, LTM, Emphasis, Tech Mahindra, all of them trading with losses of anywhere between 5 to 8% now. The top loser on the Nifty today is Infosys, 8% lower on the stock, now on the verge of breaking that 1,000 rupee level as well. But besides IT, the big trigger of the day comes from Reliance Industries, and in just a few hours from now, we'll have the company starting its 49th AGM, a whole host of issues that need to be addressed, the Jio IPO, the new energy business, and so on and so forth. And to summarize all of that, to set that up for us, Sonal is right here to take us through all of that. Sonal.
Thank you so much for that. Well, the next 12 months are going to be very important because we are looking at ramp up of solar, battery manufacturing and generation as well. Other than that, electrolyzer segment, which will see an uptick, the gigafactory that we have been talking about, segments can be notable growth areas in the medium term. So any commentary on that is something that we'll be watching out for. Now, let's take a step back and talk about FY26 because we did see massive capex being announced and done by the company as well. Consolidated capex came in at 1.44 trillion, which was an uptick of 10% on a YOY basis. However, if we talk about retail and digital segmental breakup, it came in at 54,200 crore rupees, which was a decline on a YOY basis. Oil to chemicals capex, however, was up around 22% on a YOY basis. It was led by petchem expansions. Other segment, one of that segment reported capex, which was at 52,500 crore rupees, which is up 2.1 times on a YOY basis, out of which share of new energy business came at 30,000 crore rupees itself. Now, cumulative new energy capex has been at 70,000 crore rupees till date, out of which 30,000 crore rupees happened just in the year gone by. New business continues to be the focus point because Mukesh Ambani in Q4 did indicate they are making rapid progress in operationalizing new energy gigafactory. So what is the update on that? When will it get commercialized is something that will be awaited very closely. New energy updates according to CLSA will be very important. Solar gigafactory will become operational. Battery energy and storage production will start in 2026 as well. And of course, the big one, Jio IPO hope, because in Q4, Mr. Ambani did indicate that they are advancing steadily towards the listing of Jio platform. So that is something that we'll be closely watching out for. Other than that, let's talk about the retail wave. According to a Kotak report, they've done an analysis. The retail business saw a spend of 1.9 trillion over the past decade, out of which 1.6 trillion or around 84% happened in the last 5 years alone. If we talk about oil to chemicals business and ENP, of course, these have become conventional businesses, but they remain the cash cow. So capex has slowed down here. It's just 21% of the total capex here, but very important segments to track. Now, increased focus on diversification has been the focus point for the company. Of the total 1.7 trillion capex incurred towards other businesses in the last 10 years, 1 trillion was incurred just in the past 3 years. So a lot on capex, a lot on Jio and new energy. These are some focal points for the AGM this time around.
And that's, of course, the big talking points to watch out for ahead of the AGM. Sonal, thank you for putting that together for us. There you can see the countdown on your screens. In just about 2 hours and 50 minutes from now, you'll hear live coverage of the 49th AGM of Reliance Industries, where the entire market will have their eyes set on. For the markets, well, we're still 200 points lower on the Nifty, no change there as well. Looking to hold on to some support levels of 23,900-ish on the downside. We'll get you more on the other side of this short break. Bond markets in focus with Manisha Gupta.
PLC reported.
Hello and welcome to Bond Street. Joining us today on the show is Devang Shah. He's CIO at Axis Mutual Fund. Devang, hi, thank you so much for joining in. First of all, would you want to describe to us on what Axis Mutual Fund's fixed income philosophy